A story is once again gaining traction across certain investment circles, especially online communities that have followed it for years. It centers on the Iraqi Dinar, the Vietnamese Dong, and claims that so-called redemption centers are finally opening locations where holders of these currencies can allegedly exchange them at unusually favorable rates. For anyone who owns these currencies or has tracked this narrative for a long time, it's critical to separate facts from speculation and understand the actual financial reality behind these claims. Let's start with what's being claimed. The main idea being promoted is that official redemption centers are now or soon will be up. These locations are described as sanctioned exchange points where verified holders of Iraqi dinars or Vietnamese Dong can redeem their currency at special rates. This is being presented as a long-awaited breakthrough for people who have held these currencies for years, in anticipation of a dramatic revaluation event, often referred to as an RV. The implication is powerful. If you possess authentic notes and proper documentation, you may soon be able to exchange them for life-changing sums of money. But here's what needs to be understood immediately. This storyline is not new. Variations of it have circulated for well over a decade. The underlying promise has remained the same throughout that time, that the dinar and the dong are massively undervalued and will eventually be revalued upward by a large margin. The problem is simple and unavoidable. This prediction has repeatedly failed. The Iraqi dinar has traded within a relatively tight range for years. The Vietnamese dong, rather than appreciating, has gradually weakened over time. So when talk resurfaces about redemption centers going live, the most important question becomes, at what exchange rate? That's where the entire claim begins to break down. If such redemption centers existed and were legitimate, they would exchange currency at prevailing market rates. That's how lawful foreign exchange works. Right now, anyone can exchange Iraqi dinars or Vietnamese dong through banks or licensed currency exchangers. Their prices are publicly available and transparently set by the market. Currently, the Iraqi dinar trades roughly between 1,300 and 1,460 dinars per US dollar depending on the rate referenced. The Vietnamese dong trades around 24,000 to 25,000 per US dollar. These levels have been stable, and there is no indication from central banks, governments, or global financial institutions that a major revaluation is approaching. So what are people really referring to when they talk about redemption centers? There are legitimate currency reforms and exchange programs in the world. Iraq has implemented monetary adjustments in the past. Vietnam actively manages its exchange rate. But the idea that secret or semi-private centers exist offering rates vastly different from global markets is incompatible with how modern financial systems function. From a market perspective, currency values do not change through isolated exchange programs. They move through central bank policy decisions, economic fundamentals, and international currency markets. If Iraq or Vietnam were planning a major upward revaluation, it would be publicly announced. Global media outlets like Reuters or Bloomberg would report it. Investors would react immediately. Currency markets would shift. None of that is happening. Instead, this narrative lives primarily within niche online ecosystems, YouTube channels, private forums, email groups, where it has developed its own language and assumptions. Phrases like verified holders, authenticated currency, phased rollouts, and appointment-only exchanges appear frequently. Yet these terms are completely absent from official communications or reputable financial journalism. That absence is a major warning sign. Interestingly, much of the guidance being offered within these communities focuses on preparing for fraud. People are advised to authenticate notes, document holdings, and avoid scammers. This advice is sensible, but it also unintentionally highlights the core issue. Fraud has been widespread in this space. There have been numerous cases of counterfeit dinars being sold to investors. Others have been persuaded to pay upfront fees for access to supposedly special exchange rates. Some have been directed to fake appointment systems or sham redemption processes. Regulatory agencies, including the FBI, the Better Business Bureau, and multiple state securities offices, have issued public warnings about dinar-based investment schemes. So yes, if someone holds these currencies, verifying authenticity is important. But that verification should only happen through legitimate banks or licensed currency professionals, not through private groups or online personalities promoting redemption events. To truly understand why the revaluation story doesn't hold up, you have to look at economic fundamentals. Iraq's economy is heavily reliant on oil exports, and its currency reflects that reality. Ongoing political instability, infrastructure challenges, and fiscal pressures make a sudden massive appreciation of the dinar extremely unlikely. These conditions simply do not support the kind of upward revaluation being promised. Vietnam's situation is different, but no more supportive of the claim. The Vietnamese government operates a managed currency system designed to support exports. A sharply stronger dong would reduce export competitiveness, hurting one of the country's primary economic engines. From a policy standpoint, a dramatic revaluation would work against Vietnam's economic objectives. There's another overlooked factor. Central bank reserves and monetary structure. Large currency reevaluations typically occur in countries with strong reserves, low inflation, sustained trade surpluses, and long-term stability. Neither Iraq nor Vietnam fits that profile in a way that would justify an abrupt upward reset of their currencies. What is happening is far less dramatic. Both countries are gradually modernizing their financial systems. Iraq has discussed redenomination and structural currency reforms. Vietnam periodically adjusts its exchange rate policy. These are routine monetary management actions, not secret wealth transfers for foreign currency holders. The persistence of this story is largely psychological. Many people have held these currencies for years. The longer someone waits, the harder it becomes to admit the original premise may have been flawed. This is known as the sunk cost fallacy. When new rumors emerge, they're interpreted as confirmation that success is finally near. When predictions fail, the explanation changes. It's now behind the scenes. It's delayed for security reasons. It's happening in stages. Redemption centers are open, but not for everyone yet. The timeline keeps shifting, but the promised outcome never arrives. This pattern is common in speculative schemes built on hope rather than evidence. To see the difference, consider how legitimate currency exchanges actually work. You go to a bank or licensed exchanger. You present valid identification. You receive the current market rate minus a small fee. There are no exclusive programs, no secret appointments, no insider rates. If a genuine revaluation were planned, you'd see coordinated announcements, policy explanations, international media coverage, and clear public procedures. None of that exists here. What should someone holding these currencies realistically do? If they want out, they can exchange them at current market rates through standard channels, accepting any loss incurred from buying at inflated prices. If they want to hold them as a speculative currency position, that's a personal choice, but it should be viewed as a normal Forex investment with normal risks, including depreciation. What they should not do is make financial decisions based on the expectation of special redemption centers offering extraordinary rates. That concept is unsupported, inconsistent with economic reality, and contradicted by years of evidence. There's also an important opportunity cost lesson here. Capital tied up in these currencies for a decade missed out on real growth opportunities. Equities, property, and even conservative investments have significantly outperformed. The true cost isn't just the currency's value, it's everything that money could have become elsewhere. So where does this leave us? The redemption center narrative surrounding the Iraqi dinar and Vietnamese dong is not supported by credible evidence. The warnings about fraud are justified, but they don't validate the revaluation theory itself. These currencies are not lottery tickets waiting for activation. They are ordinary foreign currencies trading at transparent market rates. This story matters beyond these specific currencies. It serves as a broader lesson in financial literacy and critical thinking. Whenever an investment promise relies on insider information, LAX mainstream validation keeps delaying its payoff and promises extraordinary returns. Caution is not optional. Real currency reevaluations happen in the open. They're announced, analyzed, and documented. They don't require secret access or special centers. Until credible institutions say otherwise, the evidence points in one direction. Protect your capital, rely on verifiable sources, and treat extraordinary financial claims with the scrutiny they demand. After more than a decade of failed predictions, skepticism isn't pessimism, it's prudence. At the end of the day, the claims surrounding Iraqi dinar and Vietnamese dong redemption centers do not hold up under serious scrutiny. There is no credible evidence from central banks, governments, or international financial institutions to support the idea of special exchange programs, offering rates far above the open market. Currency markets do not function through private appointments or secret locations. They operate through transparent policy decisions, economic fundamentals, and global market forces. What has kept this narrative alive is not factual confirmation, but hope reinforced by repetition. Over time, speculation has been mistaken for inevitability, and rumors have been treated as signals. Unfortunately, financial history shows that when an investment story depends on insider access, shifting timelines, and the absence of mainstream verification, the risk is exceptionally high. That does not mean holding foreign currency is inherently wrong. It simply means it should be understood for what it actually is: a standard foreign exchange position with normal risks and modest potential movement, not a guaranteed wealth event. Investors are best served by relying on verifiable information, official sources, and basic economic logic rather than emotionally compelling narratives. After more than a decade of unfulfilled promises, skepticism is not negativity, it is discipline. In financial markets, protecting capital matters more than chasing unlikely outcomes. Real opportunities do not require secrecy, urgency, or belief. They stand up to transparency, evidence, and time. **** When all the claims are stripped down to verifiable facts, the reality becomes clear. The idea of exclusive redemption centers exchanging Iraqi dinars or Vietnamese Dong at extraordinary rates is not supported by how global financial systems operate. Currency values are not unlocked through private processes or hidden programs. They change only through formal central bank action, economic performance, and market consensus, and those shifts are public, documented, and immediately reflected in exchange markets worldwide. What continues to fuel this narrative is not confirmation, but expectation. Over time, repeated speculation has created a self-reinforcing belief system where delays are reframed as progress and silence is interpreted as secrecy rather than absence of evidence. This is a dangerous pattern in any investment environment, because it replaces analysis with anticipation. For individuals who still hold these currencies, the most responsible approach is clarity. Understand what you own, know its real market value, and recognize both the risks and limitations involved. Any future movement in the dinar or dong, if it occurs, is likely to be incremental and tied to measurable economic improvement, not a sudden, transformative event benefiting a select group of holders. The broader lesson extends beyond this specific case. Sustainable financial gains do not rely on insider stories, restricted access, or promises that have remained just around the corner for years. They come from transparent markets, sound fundamentals, and decisions grounded in evidence rather than emotion. In finance, patience is valuable, but only when it is paired with realism. Hope without proof is not a strategy. Critical thinking is, and in an environment filled with noise, those who prioritize facts over narratives are ultimately the ones who protect their capital and their peace of mind.